Welcome to Scalpers University, Module 3, Lesson 2. Lesson is mean reversion. So, part of the price action series. And we covered in the last lesson about market structure, which is the most important concept within price action trading for obvious reasons. Markets are always either in an uptrend or a downtrend on various time frames. And it's important to know what denotes an uptrend and a downtrend, how to trade around that. The next most important concept to go along with that would be the one of mean reversion. Mean reversion ties in perfectly with market structure because it adheres to the same principles. This is going to be different to some of the modules before. It's going to be purely based on the chart, as are most of the lessons moving forward, especially with price action. It's going to be a lot more practical. We've done all the slideshows and stuff on the psychology and risk management, etc. This is where we're really taking it into real world examples and showing you guys exactly how to trade based on that. So, mean reversion, in terms of an actual definition, mean reversion is commonly thought of as the assumption that price will return back to an average over time. Okay, so a typical measurement for mean reversion would be using a moving average. So I'm sure everyone by this stage, if you're here, you know what a moving average is. You got the 200-day moving average, you got the 50-day moving average, you got the 100-day moving average. They're quite common ones for using. People base their analysis off, that if we're too far away from a moving average, a specific moving average, then we are more likely to trade back towards that. It's not direction specific. So if we're too far below a certain moving average, the assumption is that we will trade upwards towards it. If we're too far above a certain moving average, the assumption is that we will trade downwards back to it. So using mean reversion as a strategy for trading means you have to be able to identify a range for trading, and then also being able to find out what this average price is. All right, so there are many different ways of doing it. You can use time-based, volume-based, or purely price action-based, and we'll talk about all of those now. So to more clearly illustrate it, we'll jump into the chart, and we'll take a look here. So I'm going to put on a 200-day moving average. We'll talk about moving average first, all right? So for Bitcoin, a very common bull and bear measurement, I suppose you could say, or metric, is the 200-day moving average. So if you go way back, people typically call this the dividing line between bull and bear. You can see that in the past, I'll probably have to pull it up a little bit more. You can see that in the past, Bitcoin has traditionally stayed above this moving average when in a bull market. And then, of course, at the peak of a bull, you deviate massively from it, meaning you go way, way above it. So here, you're hugging it within whatever, Let's say here, you're about 30% away from it. Here, you're about 50% away from it. I suppose the percentages won't actually change massively, but you can deviate in terms of price way up here as far as 70% from it. So obviously, the longer that goes on, the less sustainable it becomes. That's the feature of a bull market, sorry. Then we obviously trade back towards this level, get some type of reaction in around it, and start to trade a bit more closely to it. We now fall below it, test it multiple times, and stay below it for the entirety of a bear market. This is the bear market here, as you can see. We then traded back above it in what was a bear market rally, yes, because we didn't make a new all-time high. But in essence, from April till the end of June, so 3 months, you had a mini bull trend or a mini uptrend rally, whatever you want to call it. But we obviously significantly deviated above the moving average again before trading back towards it and chopping around above and below it. So a key feature of this would be that price will typically want to return to that moving average over a certain period of time. It's not perfect. And as you can see with this 2021, 2022 bull and bear, we did the same thing where we traded above it. We deviated significantly from it. We came back to it, but it didn't really respect it. I mean, it tore right down through it, then bounced to it. But then we traded below it for quite a while. We bounced up above it. There's nothing. I mean, you can take longs here saying that we're so far below it that it's good to take a long towards it. But also people were saying that here. They were like, look how far below the 200 we are. I'm going to go long. And we go down even lower. So, and this will make sense in a moment, but I want to continue talking about the moving average. So the moving average is a metric to use. One metric you can use for finding when price is overextended. In my experience, it's more relevant and more actionable on the upside. So for indicating when you should take profit rather than when you should go long. Reason being is that when we started to extend, like here, even here was extreme, we got a pullback, but when we went up here and you're really, really far away from this moving average, you should be starting to take profits because chances are we going to keep going up? I mean, of course we can do anything, but price will not keep going up forever because people will start to take profits. Price can go down, not forever, but price can go down for longer because people they're not taking profits. They're either leaving the market totally or they are capitulating, selling their bags, trying to buy them back lower, whatever. Price can go down and down and down and just stay down for a long time. Price cannot stay up for a very long time because the longer it stays up, the more people are in profit, and the longer it goes up without really making a big move, the more likely it is people will start taking profits. Once they start taking profits, it creates a chain reaction and a downward spiral. Okay, I hope that makes sense. The 2017 bear market is probably the best. 2018 bear market is probably the best example of this. We deviated way above it, but not for long because people thought, okay, it's time to take profit. Once they start taking profit, it drops very fast. Then when you start going sideways like this, we went downward, we went down and sideways for a long time, including a final drop for years, literally 2 years. 1 year for this part, but then obviously we still remained in a bear market and retested. But for at least 1 full year, we went down and sideways. That's because a bear market differs in that there's a lack of buyers and there are unwilling sellers. In a bull market, you have an abundance of buyers and willing sellers because whales are smart and they will sell whenever it gets into the euphoric phase. Like here, they'll sell in this area. But because it's a bull market and because crypto participants are typically long biased, the average dumb retailer, whoever you want to call them, the new generation who enter and think that crypto is going to the moon, they will think, they don't understand any of this. They will think that 50K is a good buy because it's going to 100. That's what they're told. That's what all the news says. So the reflexivity on the upside creates both buying pressure, guaranteed buyers to buy your bags, but also smart money is exiting. So that's why, and especially when you get to these peak levels, the smart money tends to exit fast and quickly overwhelms the new buyers, and you start to drop off like we did. So you have more market participation in a bull market than a bear market, which is why price moves faster. Okay? If you have more market participation, it doesn't matter, forget buying and selling. If you have more market participation, price will move faster because more people are in it, more opinions are conflicting. Some think up, some think down, some taking profits, some are buying more. In a bull market, you get all that euphoria. The volumes are higher, the activity's higher, altcoins are going crazy, news is all bullish, activity's super high. You all remember this from either November 2021 or April, May 2021. You remember it. In a bear market, it's different. If you remember this mini bear, basically everyone gave up. They're like, fuck this, crypto's dead, blah, blah, blah. And they leave. They do nothing. They stop checking the charts. They stop buying coins. They stop whatever, you know. So that's why you get lower volatility, as in it chops sideways and barely moves. And it also takes longer. So this up move, this final part of the first leg of the bull market, was shorter than this, but it felt, and it felt shorter because these times always feel longer. But even though Bitcoin wasn't doing much here, altcoins were going crazy. But whenever we had this downward spiral, Bitcoin was down like this, and so was every other coin, because the general interest just disappears. Again, second time we come up, even shorter again. And now look at that, we're in a bear. It goes sideways and down, and it'll continue to do this for another number of months. So mean reversion, when we bounce, when we do finally bottom out, and we continue to, we get a little bit of relief to the upside, we should trade back towards this level, right? I don't particularly like moving average, and I'm going to move on to the one I prefer next. But typically, a lot of people do use moving average. So in terms of your mean reversion strategy, and especially as a scalper, I don't think moving average is a great one to use. Obviously, you can see here that on this daily chart, it kind of roughly trades back to it, kind of uses it as a bit of an anchor, a couple of decent touches of it. But we're not swing or position traders, we're scalpers. We're trying to learn how to trade on daily timeframes. So for mean reversion on the lower timeframes, what I prefer is using volume. So the VWAP, which is the volume weighted average price. It's just another way of calculating an average price. The moving average is the same thing. It just bases it off time and price. Volume is based off, obviously, volume. So if we clear this, pull up the VWAP. These are yearly VWAP bands, and you'll see how accurate they actually are and how useful they are, especially on Bitcoin, since we got more institutional activity, which was in around the early 2021. First thing to note, these are yearly bands, which is why they kind of gap and disappear in each January. Because after we hit the January, they start again. So they took a while to develop. Again here, January, they take a while to develop because you don't have any volume. It starts again from zero each year. But look at 2021. So we moved up, we set the high, we bounced to the middle, we set the high, we bounced to the middle, we set the high, we bounced to the middle. Once we lost that and we started downtrending, we trended down to the bottom. We then respected the bottom bands all the way through the mini bear market. Then when we bounced to the middle, we found some resistance. We then pushed all the way up to the top and almost exactly respected the top again before dropping back to the middle, almost perfectly, and then dropping down. Obviously, we then went into the next year, but you can see that we headed down towards where the previous year's low was. And even this year, look what we did as we started to set them. We're setting the new bands. So if you're going to trade on the longer time frame with the daily, with the yearly view up, obviously they don't become super useful until maybe February or March. But after February, went into March, went from the high to the middle, to the high again, to the middle, to the low. And then we had the first real break of them, which was here. But we are in unprecedented market conditions, as everyone knows, with Fed liquidity, etc. So we have kind of violated them to the downside here. But I think as we start to bottom out, these bands will become more relevant, more useful this year. I do think we go lower, but I think when we get the bear market bounce of 2022, whenever that comes, and obviously you could be watching this in the future and it's already happened, I think we'll bounce to this midpoint as a bear market rally, wherever that may be. Notice that as we go down, the bands also drop, so it's not going to be 33K by the time it happens. If we go down to 14 or whatever, and we take a few months to reaccumulate and we push up, the bands will probably be in the mid to high 20s, and we probably bounce to there. So anyway, that's just an introduction to VWAP, just to show you visually how using VWAP for mean reversion is much better than just a moving average. Right? So you might notice as well that the moving average was just one line. The VWAP gives you three, so it gives you bands. It gives you an extreme to the upside, an extreme to the downside, and a midpoint. That's important because you need to know where you should roughly be getting in for your long or your short. These bands work with what's called standard deviations. I'm not going to go into that. I'm not going to get too mathematical with you. But each band represents a 2 SD, so a 2 standard deviation from the mean, which is the middle, the VWAP, the volume weighted average price. The reason these work quite well is because it's using volume as a metric is something that has been common in traditional finance for a long time. VWAP is a way that quants and hedge funds do trade, because it's not mystical, it's not woo-woo, it's not a chart pattern. It's based off volume. If you think about what volume really is, volume means there is a buyer and a seller. So once one person buys Bitcoin, one person sells it, that puts one BTC of transaction volume onto the books, or two, depending on how you measure it. You can either say that one person bought, one person sold, one contract was traded, depending if you're using spot, depending if you're using futures. So when you talk about volume, if you have a line that represents where the most volume was traded on an ongoing basis, it's very, very reliable and logical to assume that that is the price that you could call fair value, in air quotes. The fair value of Bitcoin will always be the price at which the most volume was traded, because that means the market agreed, in terms of buying and selling and transaction, that that was the most active part, and that is where they see Bitcoin should be. Again, air quotes, because of course it doesn't happen. It doesn't mean that we're going to bounce to 33K right now just because it's fair value. But you can see why volume is a better metric than just time or price. Because volume is actually tangible. That is real people doing real activity. Time is just time. Time is just seconds, minutes, hours, days. Price in itself is not a valuable metric, because price is ambiguous. The price that Bitcoin is now doesn't have any bearing or any relation to where the price is going to be next week or was last week. But when you talk about volume, you can begin to make an assumption based on some type of logic. You can take an educated guess. The price should really trade at a certain level because of volume. So if I have a volume on this, which it don't, that doesn't matter. What price doesn't tell you, and I'll remove these bands, what price alone, just this, what this doesn't tell you is how much was traded at each level. If we had the volume bar, which I'll actually add it because it is quite important. Volume, here we go. You can see that at this instance where we hit 28K, there was massive volume. So that's more significant. A lot of volume was traded here. Whereas when we were here, all the way between 44 and 38, there wasn't much. Relatively, there wasn't much. So by just saying price was, price spent, here's a good way of framing it. Price spent a lot of time in this area. So it spent a lot of time between 37 and 47, all right? Lots of time. 47, this is super rough, but you'll get the idea. 37, and we were there between, 90 days. From this bottom here where it made a bit of a range, okay? For 90 days, we traded between 47 and 37. And so someone could say, well, that's fair value. It traded there for a long time. That's where we should be. We should return to that. But look, the volume was never, apart from this one bar, the volume was never significant. In fact, it was reducing, which is a bad sign. It shows lower interest, lower activity. And then when we drop off, you see some massive spikes in volume in these areas. So there's a lot more interest at these levels. Volume equals interest. Doesn't matter whether it's bullish, bearish, or neutral. Volume means people wanted to trade or were forced to trade if they're getting liquidated, but they still were trading. So this now becomes much more significant than this. And you always go based off recency as well. The most recent price is the most relevant. So all of this kind of insignificant volume has been trumped by this massive volume here. So what that would mean to me is if we do bounce, let's say up into here, we probably don't go above this block or this one. We might just get above that, but we'll probably drop back in because so much volume has been transacted here. The price is more likely to accept around these levels and do something like that, form a new range in this area. It's very unlikely that it goes all the way back up here because we already know that people don't really care. They're not really interested there. Not yet. They're more interested here. So there's going to be more activity where there is more interest. All right. So in terms of mean reversion, when you're looking at that from through the lens of volume, you want to look at it as using the VWAP, which let me add. Here we go. And this is just a basic VWAP. All right, oh no, that's one with a crappy indicator. So if we're looking at, I'm going to a lower time frame now because obviously you want to keep it relevant for scalpers. You want to look at how VWAP gets affected on a daily basis. Now, have I got a good VWAP on this? I use the VWAP on my actual FTX exchange interface. So I don't use it so often on this because when you're live trading, it's more useful. So, oh yeah, sorry, here we go. So there's the volume weighted average price. You can see these bands. I'll just check the settings. Anchor period is the session, which is a day. That's good. And time frame for the chart, that's fine. You do not need, well, you could do this. You could add the standard deviation. So you can put it 2 SD, right? Which I prefer. You can keep the 1 and the 2. So the reason for that is, as a trader, you want to trade at extremes. All right, so we'll go to an even lower time frame, so this becomes more relevant. You can see how it resets every day. I hope this makes sense. The bands are nice and wide, then they tighten in, because each day is a new VWAP. Tighten in, each day is a new VWAP, tighten in, each day is a new VWAP. You can also have weekly, where obviously it resets every week. And you can see that quite clearly. You can see here's a pretty nice example where from Monday to Sunday, we traded within the range that was set. It was set basically by, this is Monday the 20th. So by the end of Monday, we had set the high and the low of the bands, and we then traded within them for the rest of the week. So you could formulate a trading plan of mean reversion just based on that. What do I mean by mean reversion? Well, Monday, we set the low of the band, we set the high of the band, then we go into Tuesday, wait until it gets to an extreme. Don't trade here. This is the middle. When we get to the bottom band, trade back to the middle. There's an easy long trade. Get to the bottom band again, trade back to the middle. As you see it going higher, if you wanted to take some partial profits at the middle and leave some on, then you could have ridden it all the way back up to the top band, flipped short and headed back to the middle, which we obviously eventually reached in the next week. Now that's very rudimentary. I'm not saying that that is exactly how you should trade. I'm just using it as a broad example. So if you look at the weekly, if you're doing more swing trades, I would call them, and do that. But I typically use it on the daily, which is also on TradingView, which is called the session. So we'll go back to the session. We'll go to the lower time frames. I would even go to the lower time frame again, so it's more smooth and easy to see. And we'll look at the last few days. So let's go back. Let's go back as far as here. We let the action develop a little bit. We're going to move up. We drop back in here. We've set a high. We've got a low. The bands are nice and wide at this point. And you can start to look at, in confluence with other factors, if you start to see other signs of a market structure breaking and whatever, you could trade and say, okay, well, we're at the top. We're at least 1 standard deviation, if not 2. I can start to look for shorts in this area, targeting mid-range or possibly the lower end. We obviously got that move. But it's more of a tool to use in confluence with other factors, because as you can see, it's not a perfect science. You couldn't just really trade this. I mean, technically you could buy the lower band, sell it at the middle, but then you don't get quite to the lower band. So while I'm talking over this on a video, in hindsight, it's much easier and it sounds easy, but execution is all that matters. So if you were actually waiting for a tap of the 2SD band to trade back to the middle, you would have got one trade here. And that's not bad. I mean, potentially two, but in the first few hours of the session, your bands are not relevant. You need to wait, give it 8 hours until the bands have developed a bit. Because look, you can't trade that. Once they develop a bit, or if you get a big move early in the session, sure, but you need the bands to widen out a bit. Then you want to see a deviation, so a deviation down, touches the 2, trade it back to the middle. Okay, if you can define your risk and have a defined stop loss and trade it back to the middle, great. But it's not something you have to do every time. Where it is most useful is when you already have a setup based on other factors which we cover, market structure plus the other factors I'm going to cover later in Scappers University. You use your VWAP, your midpoint, as your target. All right, so you want to wait for it to go to an extreme and trade back to the middle. So if you're looking at it from that perspective, you want to be looking for typical example that I would use is, and I'm gonna remove the other bands just for a moment, so it's a bit easier to kind of visualize. We just focus on the VWAP here, and we'll find an example on low time frames of where we had a good entry trigger for a trade that we then traded back to the VWAP in a daily session. So let's take a look here. We'll be looking for an over-under pattern or an under-over pattern after an overextension to the downside or to the upside. Is this one here? You can see here when it dropped down, it bounced up, structure break here, and then you trade back to VWAP. Might not have had a clear defined risk there, but what we're looking for is in confluence with other factors. So we had a market structure level here, the last up candle before the downtrend, the last up candle before the final down push. We then broke that here, so we are on the 5 minute breaking structure bullishly and going for an uptrend. We then had a retest. You could have got long in this area and you could have targeted the VWAP and got out nicely. Now, would you have got, you can see, get in there, your target was the VWAP. If your stop was below that low, you got a profitable trade. 1.67, so good. If you were on a 1 minute time frame and getting a more tight entry, you probably could have had your stop loss there, because that is the market structure level, because it's a down candle that led to a break in structure. So price shouldn't go below there, and you could have had a 3-hour trade. Even if you enter a bit more conservatively, you could have easily had a 2-hour, right? So that is more when the VWAP becomes useful. When you get a setup and you're fairly confident that the trend has changed on the low time frame and we're going to uptrend, your VWAP is your target to exit if you get a setup and you have a clearly defined risk and reward. All right, that's the point. That's what mean reversion is. So that is essentially how I trade mean reversion. You overextend to the downside, you return to the mean. You overextend to the downside, and look, sometimes it can overextend for much longer, but you return to the mean. All right. That's not to say that every time it overextends like this, that you can just go long, because you went long, got wrecked, went long, got wrecked, went long, got wrecked. But if you waited for the structure break and you entered, you got a trade. Like everything in crypto, it's much easier to sell the overextensions to the upside and trade them back to the mean. Because when you're short in crypto, you're pretty much always in the minority, because most people in crypto still want to be long. That's just how crypto is. They're long biased. People are inherently long biased, so like any of these strategies and strategies and systems, they tend to be more actionable for shorts. So that's how VWAP works. And then the other way is just straight mean reversion, which we actually have a good sorry, not straight mean reversion. We have a good example here. It's just pure price action for mean reversion. So the dictionary definition of mean reversion is using some type of average price. I've just shown you two, volume and MA. I also trade mean reversion purely based off price action, which is what you may hear me refer to as inefficiency. When you get a move, big gap up, so the price bounces all the way up with no down candles. So instead of doing this, which is the normal way for it to move, it just goes straight up. Especially when you have 2 or 3 legs of that, like we had 1, 2, and a big wick at the top. What that's signaling to me is it's fairly good probability to look for a short in this area because you have the big move up and they often tend to come back for a retest, which I class as mean reversion. You see that? You move up. If you look at it, you've got a tight consolidation in this area. So that you could call that your fair price, in air quotes, like we mentioned before. So you can do this without even having a moving average or a VWAP. You can create your own fair prices, which is just consolidation. Then a big move up. Is it going to just continue moving up forever? Probably not. And remember, we're dealing in probabilities. We're not trying to be perfect every time. Big move up like that, chances are it's going to come back and retest this area. What does it do? Well, it moves up and then comes back. So you're looking for, as soon as you see this move, see, the problem that most people have is they let their psychology is broken because they don't understand how the markets move. They see this move and they say, damn, I missed the move. I need to get long. Price is pumping. They immediately think of higher prices. Whereas what you should be thinking is, well, that was an inefficient move. It's probably going to refill. Because people are going to start going long up here because they missed this move and they FOMO in. That is then going to create the fuel that the shorts need and the whales want to take profit so we can go lower again. So when you see those moves, you want to be looking to counter trade them. Same thing happens on the downside. When we drop down here and we kept dropping. You say, all right, price used to be here and it's dropped all the way down. It's a bit overextended. Maybe I should take a long and trade back to this area. Where does it hit? Exactly that area. And obviously then has a continuation through. But you could have just went long from there to there. That's mean reversion. So with no indicators, with no fancy tools, no nothing, just price action, you can trade this. And it's important to hone those skills. Pattern recognition is the most important thing you will have as a trader, especially as a scalper. What you want to look for are these big, obviously on my chart it's white and blue, but big red candles down, big green candles up, and you want to flip your bias and say, okay, big red candle down after a tight consolidation. We're probably going to retest this at some point, so I'm going to look for longs. Again, in confluence, you need to see some other factors that tell you that you might be able to go long. You can't just blindly enter long because there was 2 big candles here. If you would have went long there because of 2 big candles, you got wrecked. But if you know how markets move, especially on the downside, you have multiple pushes lower. And this is getting a little off topic of mean reversion, so I'll not spend too much time on it. The first drop down, you set a low. What do people do in crypto? They go long. They use leverage. They do it too early. Never enter on the first drop. Second one, people go long again. That's a target. Take it out the third time. Then you can start looking for longs. We happen to have a fourth, but that doesn't always happen. But after this third one, when we bounce back into range here, I'll be looking for longs. Buy a little there, see how it develops, maybe buy a little there, and eventually you get your run back to here. All depends, obviously, do you have a defined stop loss where somewhere you can put your stop, but you get the idea. And that's enough of that for now. We'll touch on that a lot more in future lessons. But always be looking for your mean reversion and look at how accurate it can be just with price action. You can use 2 things, price action and order blocks. Order blocks will be covered a lot more in a future lesson, but an order block is just a collection of up candles that led to the break in structure. You can see this. There was the low of the structure level. We broke below it. So what led to it? That means all this buying led to this selling. That's a significant level. Something significant happened there. That becomes your level. Big drop down. Let price develop. You see a sweep. You see a retest. You decide to get long in here. Where's your target? Filling up that white candle. Perfectly fills it into that area and then sells off. That is mean reversion. Look at it. Big move down. Ignore what happens in here. The move up happens. Sometimes you're going to have a big move down and an immediate move up. V reversal, it's called. Very rare in crypto these days. There's just too much liquidity. There's too many different players in the market. It doesn't tend to happen. But that's one type of mean reversion you can have. Big move down, double bottom, move up. That's quite a common one. The one I like, big move down, set a low, sweep the low, break the structure, move up, also known as an under-over. And of course, all of these are just as relevant the other way around at the top. You also have the kind of choppy, not even a W bottom, even more than that, kind of like this one, where it drops down, it doesn't really sweep the liquidity, it doesn't do an over-under, under-over, it just chops. That's quite common these days as well. So big gap down, just chops. Maybe upwards, maybe downwards, no real sweep, and then back up. Any of those. Look for any of those. Your main thing is the big gap down or up. Again, like I said, big gap down or a big gap up, same thing. Some type of price action to develop, and then trade it backwards. Trade it the other way. So the purpose of that, and why you don't need to worry too much about what happens in between, is you want to be looking for when is the downside momentum slowing, and do I have a target for mean reversion? So let's find another example, and let's find an example on the upside where you could get a short. The downside ones, although there's more clear downside ones, so we'll use these because there's some nice good examples. You've got a nice tight range here, consolidation within a bigger range. We had some consolidation here, big gap down. Obviously don't enter on the first one. We had another drop down. You got an initial big move back up to here, but this wasn't really mean reversion. This was fairly efficient. It wasn't a big gap down. So when it came up to here, there's no point going long here, but when you get this retest, it's a perfect time to take a long because you still have the gap up here. You still have this that needs to be retested. You now also have a clearly defined lower time frame invalidation at this level. The reason that's a defined invalidation is because on this breakdown, we had the reaction. You can see clearly market structure has been broken. So we have a potential of an uptrend. And then you're lucky enough to get a retest. Not only that, but you get another chance with a low time frame under over, which confirms around here. And you go long there with a stop there. Or, because you had the first, because this move told you that it was likely to go higher, you could have just entered here, entered anywhere there, targeting back up to this block. So you could have targeted, it would have closed out here eventually after the full retracement of it. And that's your mean reversion, all right? What happens thereafter doesn't really matter. All you're trying to do is catch a scalp in between. Scalp, day trade, whatever. Swing trade, sometimes these trades take 2 days. Don't obsess over that. Don't obsess over the word scalping. That's not super important. These concepts apply on all time frames. Here's a good example. Price runs up, inefficient, shows a distribution pattern. This one was literally nailed on, perfect. Price moved up, chopped around, set a high. Again, we're talking about using confluence. Swept the highs, broke back below, broke down below the market structure level, and even give you a perfect retest before a deep sell-off and a full reversion to the downside. Then it reaccumulated, and again, because an inefficient move is an inefficient move, it bounced all the way up to here, and then down again and up again. This was a trader's dream, if you're looking at it now in hindsight. The goal for you as a trader is to be able to spot these in real time. It's not really that hard. You let price develop, look for big gaps, big inefficient moves, and then trade the fill-in of them. And then trade the fill-in of them again. And then trade the fill-in of them again. And again, here, until eventually the crazy volatility is gone and it starts to move more efficiently like this, where it is going up and down and up and down and up and down and up and down until you get the next gap. All right? So what you're looking at there is a perfect way to determine mean reversion setups with no indicators. So that pretty much covers the price action element of it and how you can spot them. You can notice even here, this big gap down, where did the future gap up go to? Filled it perfectly. This happens time and time and time and time and time again. Gap up, gap down, gap up, gap down, bounces to fill the gap again. I mean, it's not easy, of course. Trading isn't easy. You have to master your emotions, you have to manage risk, etc. But I think you can see pretty clearly that mean reversion is a valid way to trade and probably the easiest way for anyone to trade, any new trader. It requires the least amount of thinking, because what you have to say is what? I'm going to wait for price to tell me what to do, and then I'm just going to fill in the gaps. That's it. I'm going to wait for price to go down like this, leave it, let it develop. This is over a day or two. These are 15-minute candles. There's no rush. Let it develop. But you know that after this gap down, it's probably going to go up. So look for a setup. If you get one, go long. If you don't get one, that's fine. There's always more trades. So that price action, if you want to then use that in confluence with other things, if you want to put on your moving average, if you want to use bands, you've got like mean reversion bands like here, like these. So let's say you see the gap down. You're like, okay, it's gap down, but we're only in the top cloud, top part of this cloud. Touches again, touches again, touches again. You're below the midline. You could take a long, trades it back up. Maybe, maybe not. I wouldn't say that was such a strong signal on the reversion bands. And the reversion bands are the same type of thing. It's a moving average plus some deviations. Obviously, the reason it's color coded is that if you touch into the red band, like we did here today, it's a very strong signal to go short, because it means it's super overextended in one direction or the other. So if you already had reason to go short here, this is adding confidence. You then have a defined target, which is the midpoint, and then potentially down to the lower band, which brings you back to this old consolidation. So it's one way of trading. I just tend to use the purely price action and VWAP. But up to you to develop your own strategy based on that. But I think this covers quite well what mean reversion is and how you should best use it. There's one other concept, I suppose, that should be added to this, which is the CME. So Bitcoin CME futures. The CME is the Chicago Mercantile Exchange. It is the traditional finance. The US markets trade on the CME. They trade on a number of things, obviously, New York Stock Exchange, etc. But the CME is a large, well-established, prestigious exchange, and they offer Bitcoin futures. This is where most Americans can get significant size and interest onto Bitcoin, because as you know, if you're in America, it's quite difficult to trade crypto, very difficult to trade futures contracts. You just have to typically buy crypto. You can't really trade on perpetuals, etc. But on the CME, you can buy and sell Bitcoin futures contracts. Now, the reason this is significant is because the CME trades based upon the stock market. So it's open from Sunday night, when the futures market's open, until Friday evening. It's not open at the weekends. Meaning that price, unlike Bitcoin, price finishes on Friday, as you can see here, finishes on Friday at 9 p.m. That's in my time zone, UTC +1. If you're in America, it's like 4 p.m. or whatever. If you're in New York, sorry. Closes on Friday and reopens on Sunday night. If you look at the time on the bottom and the date, closes on the 15th of June at 9 p.m., reopens on the 15th of June at 11. Oh, sorry, my mistake. That's the wrong one. Let me find one. Let me find one which actually represents the weekend. Here we go. Closes on the 10th of June at 9 p.m., reopens on the 12th of June at 11 p.m. That means it closes on Friday evening and opens on Sunday night. All right, so what happens in between? In between that is what Bitcoin does in the real world, because Bitcoin trades 24/7. So that's why you get a gap, because on Friday, when the Americans were trading, it finished there. On Sunday, when they started trading again, it was open from there. These gaps are also something you can use as mean reversion tools or added confluence for a mean reversion trade. These gaps tend to get filled. They don't always, as you can see this one. This one will eventually get filled, but it might be months or years away. If you have other factors, so such as this is a really good example because it's a nice tight trading range and we gapped up, so we opened up with a gap and then pumped, inefficient, you can see, big candles. Then we set the top pattern, which I talked about a minute ago. When you're then trading this, not only have you got the general mean reversion we touched on, but you've also got a clear target, the CME gap. So that's a confluence of factors, as many different factors as you can that add validity to your trade. All right. So that's one way. You can see here's a nice one. Gap up, good short trade, trade it back down, fills it. Nice and easy. So those are the main topics or points to cover for mean reversion. You've got moving averages, volume weighted average price, purely price action, filling gaps on the CME. That's all you need to know. Rewatch this, start to look for them on the chart. Just hone your pattern recognition skills, add your indicator, add your moving average or a VWAP, whatever you want. If you want to use those bands, you can use the bands. But you can see now how to trade using mean reversion. And from the following lessons, you'll get other things you can add on top, your order blocks, chart patterns, etc., that all build upon that so that if you have a confirmed or something you think is a mean reversion play where it gaps up, the next lessons are going to show you how to find an entry in here to go short and how to exit down here to take profit. All right, that's everything for now. We'll move on to the next lesson after this.